Investing can be a great way to grow your wealth over time, but it can also be confusing and overwhelming, especially if you're new to the world of finance. In this guide, we'll cover the basics of investing and provide tips for getting started. What is investing? At its core, investing is using your money to buy assets that have the potential to grow in value over time. These assets can include stocks, bonds, mutual funds, real estate, and more. Why invest? Investing can help you reach your financial goals faster, whether that's buying a home, retiring comfortably, or building wealth for future generations. Unlike keeping your money in a savings account, investing allows your money to potentially grow at a higher rate, making it easier to achieve your financial goals. Types of investments. There are many types of investments to choose from, each with their own potential risks and rewards. Here are some of the most common types of investments. Stocks. Stocks represent ownership in a company and can be bought and sold on stock exchanges. Stocks offer the potential for high returns but also carry a higher level of risk. Bonds. Bonds are essentially loans made to companies or governments. They offer lower returns than stocks but are generally considered less risky. Mutual funds. A mutual fund is a pool of money from many investors that is managed by a professional fund manager. Mutual funds can invest in a variety of assets, making them a diversified investment option. Real estate. Real estate investing involves buying and selling properties, such as homes or commercial buildings, with the goal of earning a profit. Risk versus reward. All investments carry some degree of risk, but generally, the greater the risk, the greater the potential reward. Stocks, for example, can offer high returns but are also subject to market volatility and can experience significant losses. Bonds, on the other hand, are generally considered less risky but also offer lower returns. Getting started. If you're new to investing, it can be helpful to work with a financial advisor who can help you create a personalized investment plan. Here are some steps to get started. Set your goals. Before you start investing, it's important to define your financial goals. Do you want to retire comfortably, buy a home, or save for your child's education? Knowing your goals can help you make better investment decisions. Educate yourself. Investing can be complex, so take the time to educate yourself on the basics. Read books, articles, and attend workshops or seminars to learn more. Determine your risk tolerance. Your risk tolerance is your ability to handle market volatility and potential losses. This will help you determine which types of investments are best for you. Choose your investments. With your goals and risk tolerance in mind, choose investments that align with your investment plan. Diversification is key, so consider investing in a range of assets to manage risk. Monitor your investments. Keep an eye on your investments and adjust your portfolio as needed. Rebalancing your portfolio periodically can help you maintain the right balance of risk and reward. When it comes to investing, time is your greatest asset. The earlier you start investing, the more time your money has to grow, thanks to the power of compound interest. Compound interest is when the interest earned on an investment is reinvested, allowing it to earn interest on both the principal amount and the interest earned in previous periods. In short, compound interest is interest on interest. The power of compound interest is best illustrated through an example. Let's say you invest $1,000 in a stock that earns a 10% annual return. After 1 year, your investment will be worth $1,100. But instead of withdrawing the $100 in interest earned, you reinvest it. Now, your investment is worth $1,210 at the end of the second year. This cycle continues, and after 10 years, your investment would be worth $2,593.74, even if you didn't add any additional funds to it. That's the power of compound interest. Now, imagine if you started investing earlier. Let's say you invested $1,000 when you were 25 years old, and you earned that same 10% annual return. By the time you reached age 35, your investment would be worth $2,594. By age 45, it would be worth $6,727. And by age 65, it would be worth $45,259. That's the power of starting early and letting compound interest work for you. Of course, the stock market can be volatile, and there are no guarantees when it comes to investing. But historically, the stock market has generated an average annual return of around 10%. That's why it's important to start investing early, even if you can only afford to invest a small amount. The earlier you start, the more time your money has to grow, and the greater the potential for compound interest to work in your favor. Here are a few tips for harnessing the power of compound interest. Start early. As we've discussed, the earlier you start investing, the better. Even if you can only afford to invest a small amount, it's better than nothing. Over time, those small contributions can add up. Be consistent. The key to harnessing the power of compound interest is consistency. Make investing a habit and contribute to your investment portfolio on a regular basis, whether that's weekly, monthly, or quarterly. Diversify your portfolio. Investing in a variety of assets can help reduce your overall risk. Consider investing in stocks, bonds, mutual funds, and real estate, depending on your goals and risk tolerance. Reinvest your dividends. If you're investing in stocks that pay dividends, consider reinvesting those dividends to take advantage of compound interest. Keep an eye on fees. Fees can eat into your investment returns over time. Be sure to choose investments with low fees, and consider using a robo-advisor or investing app to keep your costs down. Stay the course. Investing can be nerve-wracking, especially during times of market volatility. But it's important to stay the course and not panic when the market dips. Remember, the stock market has historically recovered from downturns over time. Investing in the stock market can be overwhelming, with thousands of companies to choose from and a constantly changing landscape. But with the right strategies, you can identify promising investment opportunities and find hidden gems that have the potential to deliver strong returns over time. Here are a few tips for identifying promising investment opportunities. Do your research. Before investing in any company, it's important to do your research. Read the company's financial statements, learn about its industry and competitors, and stay up to date on any news or developments that could impact the company's stock price. The more you know about a company, the better equipped you'll be to make informed investment decisions. Look for companies with a competitive advantage. Companies with a competitive advantage are those that have something that sets them apart from their competitors, whether that's a proprietary technology, a strong brand, or a unique business model. Look for companies that have a sustainable competitive advantage, meaning they can maintain their edge over time even as the industry changes. Follow the money. Insider buying and selling can be a good indicator of a company's future prospects. If insiders, such as the CEO or board members, are buying shares of their own company, it could be a sign that they believe the stock is undervalued and has the potential to grow. On the other hand, if insiders are selling their shares, it could be a red flag that the company is facing challenges. Pay attention to growth trends. Companies that are growing quickly are often attractive to investors. Look for companies that are growing their revenue and earnings at a faster pace than their competitors, and consider the potential for future growth in their industry. Consider valuation. Even the most promising company can be a bad investment if you overpay for the stock. Look for companies that are trading at a reasonable valuation relative to their earnings, cash flow, and growth prospects. A company with a high valuation may have a lot of growth potential priced into the stock, which could make it more volatile. Don't overlook small-cap stocks. Small-cap stocks, or companies with a market capitalization of less than $2 billion, can be overlooked by Wall Street analysts and investors. However, these companies can often have significant growth potential, as they have more room to grow than larger companies. Look for small-cap companies with strong fundamentals and a competitive advantage in their industry. Consider investing in index funds. Index funds are a type of mutual fund or exchange-traded fund (ETF) that tracks a particular market index, such as the S&P 500. Investing in an index fund can be a good way to gain exposure to a broad range of companies and industries, while minimizing risk and volatility. Index funds can also be a good option for investors who don't have the time or expertise to research individual stocks. Thanks for your like and share this video.